Good evening. Okay, good evening, everyone. Welcome to this session of Corporate Connect. My name is Siva. I'm a senior editor and trainer with the Securities Investors Association of Singapore, or SIAS for short. Thank you for coming. This is a regular webinar that SIAS organizes to connect retail investors with listed companies and, of course, vice versa. Tonight's session is featuring CapitaLand China Trust. But before we go into that, I'd like to welcome the audience from Mumu and inform everyone that this webinar is not only organized by SIAS, but with the help of the support of SGX. All right. Now then, before we move on to the corporate presentation by the company itself, we have a presentation by or rather an update, a market update by the Singapore Exchange, SGX. It's usually done by their corporate strategist, Jeff Howie, but he's not available physically. However, he has sent a pre-recorded version of the latest update. So here is Jeff Howie presenting the latest market update.
Good evening, ladies and gentlemen. Thanks very much for your time. I am just going to do a quick educated overview of the S-REIT sector for the next 10 minutes. I wanted to start just by maintaining and reaffirming that our REIT and property trust market is one of the largest in Asia, and our trusts represent around 10% of our overall stock market capitalisation. And essentially, between 18 and 20 cents in every dollar that changes hand in our stock market every day is going to work in the S-REIT sector. Together, when you look at the sector from the perspective of the index, the iEdge S-REIT index, it's generated a 1.2% total return in the 2025 year through to the 2nd of May, and that's taken its 12-month total return to around 5 to 6%. The trusts themselves maintain an average gearing ratio between 39 to 40%, well below the gearing ratio limit of 50%, and they also maintain an average distribution yield between 6.5% and 7%. Together, the 40 or so trusts that collectively hold a market capitalisation of around 90 billion Singapore dollars, and this is quite an above-average figure of basically 10% of local stock market comprising REITs, and it really does highlight the significant role that these REITs and property trusts play in our financial landscape here. And importantly too, it also relays the considerable choices provided to investors who can obviously refine their REIT investments by looking at criteria such as the type of properties that make up the REIT portfolio, the geographical and currency exposures within the REIT portfolios, and of course, overall operating metrics like net property income, distributions per unit, rental reversions, asset enhancement initiatives, gearing ratios and yields, among many different metrics that investors can use to refine their investing in REITs. Currently, I think these three aspects, the type, the location, and the operating metrics, do serve as important lenses that investors can use to evaluate and triangulate upon a REIT. For instance, using the S-REIT and Property Trust chart book, in 2024, you can see Capital DC REIT. It was the digitalisation-driven related REIT. It had the most exposure to Singapore in those type of REITs. And it also, in Singapore, of course, had its GDP grow 4.4% last year. So Capital DC REIT also maintained a lower than average gearing ratio. I think it was between 31 and 32%. So that's looking, an example of last year, how you might take these three different criteria to work. Over the past 4 months, there's also been an increase focused on, number one, properties that have more economic defensive traits. Number two, countries, I guess, like Singapore that have a significant policy fuel to spur on the domestic demand if need be. And three, more maneuverability with lower gearing rates. So you take that analysis, or those three lenses, and you apply it to the S-REIT market. Among, I guess, the retail-related or the healthcare-related economically defensive REITs, those with the most Singapore exposure were Fraser Centrepoint Trust, CapitaLand Integrated Commercial Trust, Suntec REIT, Star Hill Global, and Parkway Life REIT. And then you look at among those five, you've got Parkway Life REIT and Star Hill Global. They maintain the lowest gearing ratios. And I think Star Hill Global generated 4% total return in 2025 through to May 2nd. And Parkway Life was just in the double digit range, I think up 13% total return for that period. So they obviously both outperformed the index. And look, these are just a couple of educative examples on how investors can really harness the variety of our global REIT platform. There are obviously lots of other criteria that investors can apply. Of course, you need the content, the material, and that's in our regularly updated chart book, which you can find on our website. Overall, the Singapore REIT and property trust market, I think its robustness makes it a really, as I said, a really integral part of the financial markets here in Singapore. And obviously, we're great to be working with you again and CapitaLand Retail China Trust tonight. Just another quick slide just to relay this difference between the price performances and distributions and how distributions can really have a really strong impact on total return. So they continue to maintain robust yields. Dividends themselves have boosted the total return of the IHS REIT index by as much as 20% since the end of 2019. When you look at these comparative performances on the left of the S-REIT index on a price performance only, and on the right when you're looking at the total return, which takes into account dividends. Examples, the IHS REIT index, its two heavyweights, CapitaLand Ascendas REIT. Together, they make up 20% or 1/5 of the overall IHS REIT index. And since the end of 2019, CICT, CapitaLand Integrated Commercial Trust, its unit prices declined by 12%, but distributions boost the total return to 14%. So you look at the time, the 5+ years, and the difference, you've got an annualized yield of around 4.9% for dividends. Similarly, CapitaLand Ascendas REIT, its unit prices declined by 10%, but distributions boost the total return to 18%, 18%. That implies an annualized yield of around 5% over those 5+ years. And obviously, this again highlights the importance of distributions in enhancing total returns of the S-REITs. And I think the demand for dividends is obviously clearly there when investors look to capture dividends and, I guess, mitigate some of those concentration risks that can come with all those various sub-drivers for S-REIT unit prices. Like I said before, what the property type is, where the property is located, and what are your overall operating metrics. You can see that mitigating against some of that, if you're not fully on top of all those metrics, REIT ETFs obviously provide the means to capture the dividend yields. And I think since the end of 2019, your AUM of the 5 REIT ETFs have grown significantly, almost tripled from 390 million thereabouts to close to 1.1 billion Singapore dollars at the end of last month. And that growth in REIT ETF AUM really aligns with the overall ETF market growth, which is, I think, up from, 5.5 billion at the end of 2019, getting up to close to 14 billion now. And at the same time, REITs have also increased their market share in the overall REIT offering by 1%, in the overall ETF offering by 1%. When you look at the 5 ETFs that are REIT related, CSOP IHS REIT Leaders Index ETF stands out for its yield. You can see here it's 6.17 or 6.2%, slightly higher than the yields of 6% and 5.9 offered by Nikko AM, the Straits Trading Asia ex Japan, as well as the Lion Phillip S-REIT ETF. I think also, despite having a lower gross dividend payout of around 4%, just note that UOB APAC Green ETF, when you look at the year-to-date total returns, which I actually don't have in the chart, I apologise, but if you do look at the year-to-date returns, that's actually outperformed the 5 of them. And as you can see, second best performer over the last 12 months of a 5.2% total return. So as I said, dividends and distributions are important. And there's obviously, you can see there's a demand for the distributions that come with the REIT ETFs as well. Just to, I guess, finish off this last slide, S-REITs rebounded around 10% from the April 9 lows, but still closed the month with a 2% decline. Despite the volatile month, S-REITs have remained positive year to date, with a flattish total return of around 1%. Still outperformed the FTSE EPRA REIT Global REITs Index, which is down 3 to 4%. And about half of the index constituents did deliver positive total returns in the year to date. So IHS REIT Index down 1.9% in April in total returns, slightly better than the STI, which declined 2.5% in total returns. S-REITs, I guess among the 30 constituents of the IHS REIT Index, April's performance was mixed. It was more 23 decliners, 5 gainers, and 2 unchanged. So more decliners in April than you've had year to date. The biggest decliners were ESR REIT, Mapletree Logistics Trust, and Digital Core REIT. And the strongest performances were from Fraser's Hospitality Trust, Fraser's Centrepoint Trust, CapitaLand Integrated Commercial Trust. April's performance, I guess, was marked by some fluctuations as well. If you look at the 30 constituents of the IHS REIT Index, after that volatility, as I said, all 30 of them did gain from April 9 to April 30 and retrace some of those losses that were made earlier in April. And the top gainers in that lift up post April 9 were Prime US REIT, CapitaLand China Trust, and Fraser's Hospitality Trust. The top 10 performers also saw around 23 million in net institutional inflows, while overall the net institutional outflow for the whole REIT sector in April was around 89 million Singapore dollars when you count the two counters for ESR REIT based on the share consolidation or unit consolidation they did at the end of the month. CapitaLand China's Trust, its first quarter business update was revealed in April. A high occupancy retail property portfolio occupancy rate was reported, positive rental reversions as well. Jerry Chan also noted in his COPC interview that we published last month that their malls do mainly serve China's middle income consumers, and tenants have little dependence on US imported products. And he also added that the US tariffs have introduced that overall volatility to capital markets, and the direct impact on the REIT's operations remains minimal. So I think with that observation, now would obviously be a great time to finish the update and hand over to Jerry and the CapitaLand China Trust team. Thank you very much.
Thanks to Jeff Howie from SGX for that market update. Now we move on to the corporate presentation, which will feature CapitaLand China Trust. Before we get the management involved, just a brief introduction about the company. It's Singapore's largest China-focused REIT, which has been listed on SGX since December 2006. The objective of this trust is to invest on a long-term basis in a diversified portfolio of income-producing real estate and real estate-related assets in China, Hong Kong SAR, Special Administrative Region, and Macau that are used primarily for retail, office, and industrial purposes, including business parks, logistics facilities, data centers, and integrated developments. Now, since its IPO in 2006, CapitaLand China Trust's portfolio has grown from 7 shopping malls to a diversified portfolio of 18 properties across 12 Tier 1 and leading cities in China. So today, the trust owns a portfolio of 9 retail malls, 5 business parks, and 4 logistics parks. So without further ado, I'd like to invite the CEO, Mr. Jerry Chan, and the Chief Financial Officer, Ms. Joanne Tan, to give us their corporate presentation. Over to you guys.
Thank you, Sivan. Very good evening to all. Thank you for taking time this late at night away from maybe your dinner time to attend this Corporate Connect 2025 organized by SIAS. So let me get straight into it, an introduction of CLCT and an update of our results, as well as our latest progress and happenings. CLCT is the first and largest China-focused S-REIT. It is a trusted proxy to China's future domestic growth opportunities. We have 18 properties across 12 key cities. We're supported by our strong sponsor, CapitaLand Investment, who has an established 30-year track record in China. Its AUM in China, this CapitaLand Investment is 136 billion Sing dollars. It also owns 24% stake in CLCT. In terms of our asset allocation, retail is CLCT's largest and most resilient asset class. Retail is 71.4% of the portfolio by gross rental income. This is a key asset class for us, and it's positioned to benefit from government initiatives aimed at boosting domestic consumption. The other parts of our portfolio consist of business parks, which is at 25.1% by GRI, and logistics parks, which is at 3.5% by GRI. These two sectors, commonly known as new economy sectors, they are strategically aligned with China's technology and innovation-driven agenda, and it provides exposure to key sectors such as semiconductors, electronics, and ICT. Over the years, we have grown and pivoted from a retail pure play when we first IPO'd. When we first IPO'd, we were only consisting of retail malls. That was until 2019. During the COVID period of 2020 to 2021, we pivoted to new economic sectors, business parks and logistics parks, in order to diversify away from retail, which of course suffered during the COVID period. After 2021, from 2022 onwards, we focus on portfolio optimization. We have done a few AEIs. We have ceased operations of some of our poorer performers, like Capital Mall, Qibao, and sold some assets like Capital Mall Shuangqing, unlocking some of the value from the matured mall. In 2025, which is recent, we announced a proposed participation in CapitaLand Commercial C-REIT, CLCR, and this is an important and strategic initiative by us. I will cover it a little bit in a little bit more detail later. But as you can see, over the years, we have done quite a number of things to pivot into new sectors, to diversify, as well as start portfolio reconstitution and other strategic initiatives to drive unit holder value. In terms of 2025, we are focusing on driving asset performance, reconstituting our portfolio, as well as working on financial management. If you look at our yields, it is now currently about 8%, which is attractive if you compare it to the S-REIT market, the benchmark yields. We have a good spread of about 3% against the REIT benchmark yields, as well as the STI index yields. Earlier last month, actually we shared with the market that our sponsor CLI and also with CLD, CLCT submitted an application to list a C-REIT on the Shanghai Stock Exchange. This proposed C-REIT is what is known as a retail C-REIT. The retail C-REIT mandate is to invest only in wholly owned income-producing retail assets in mainland China. CLCT itself intends to contribute Capital Mall Yuhuating, which is a tier 2, which is a mall in the tier 2 city of Changsha, as a seed asset to the C-REIT. whereas CLI and CLD intends to contribute Capital Mall Sky Plus in the city of Guangzhou, which is a Tier 1 city. Together with CLI and CLD, CLCT will be a joint strategic investor to this series, which will be the first international sponsored retail series in China. The 3 strategic investors intend to collectively subscribe up to about 20% of the IPO units. Both the proposed divestment of Yuhuating and the proposed subscription by CLCT to the C-REIT are considered IPTs and subject to unit holders' approval in the EGM. For CLCT, this is a strategic opportunity to differentiate ourselves and get access to an onshore C-REIT platform through which we can tap domestic liquidity in China and which we can use to recycle our assets and unlock value. We also continue to enjoy a ROFR from CLI, our original existing ROFR that we have held on to since our IPO. In terms of the use of proceeds after our listing, we may use the net proceeds from recycling Yuhuating to pay down debt, reduce leverage, and also potentially do unit buybacks or combination of both, depending on our financial situation then. There are some differences between CLCT and the C-REIT. For one, CLCT is more established and we target global investors outside China. CLCR, which is the C-REIT, is predominantly is wholly focusing on PRC domestic investors. CLCT is also more diversified. It is a multi-asset class vehicle. We currently hold retail, logistics, and business parks assets, but we could also hold other asset classes. Whereas the C-REIT can only focus on one asset class, and in this case, they are only focusing on income-producing retail assets. CLCT is also more flexible in other ways. For example, we can, in fact, invest in partial stakes of assets. We can also undertake property development or do more value-add opportunities like AEIs. And in terms of the leverage, we can also take more leverage than the C-REIT. So there are a few things that makes generally a S-REIT, China-focused S-REIT more flexible than the domestic C-REIT in the Asian market. Next, let me go to the first Q 2025 business update. For the first Q, our gross revenue declined by 6.1% year-on-year, and the IPI declined by 6.6% year-on-year. Now, one thing to note was that in first Q 2024, it was generally a stronger period as compared to 2025 for many China players in retail and business park space. Right, so our results also reflect those trends. If you look at our results, if we exclude some of the things that are one-offs, we had a business park service office tenant that pre-terminated, and we are also currently doing big supermarket upgrading in 3 of our malls, which is Capital Mall Wangjing, Xizimen, and Xuefu. And those activities certainly did affect our results. So if we exclude both those activities, our gross revenue would have dropped by 4.4%, and the NPI would have dropped by 4%. In terms of retail revenue, excluding the supermarket upgrading I mentioned, that declined by 2.7%, due mainly to lower rents at Capital Mall Xingnan. Business park revenue declined by 9.6%, largely due to the lower occupancy at Hangzhou Phase 2, as well as Ascendas Innovation Towers, which had vacancy that we are working to fill. Logistics parks increased by 3.3% due to increase in occupancy at Kunshan Logistics Park. Decline in NPI was generally due to drop in gross revenue, partially offset by savings in operating expenses of 5% year-on-year for the overall portfolio. Key milestones for first Q, I've already mentioned our proposed participation in CapitaLand Commercial Series, which is a strategic initiative that will really differentiate us from other series. We have also done other things on the capital management part. We have successfully launched a 600 million renminbi bond that is at an attractive rate of 2.88%, and this is lower than the last CNH renminbi bond that we did, which was at 2.9%. In terms of the renminbi denominated debt proportion, we have pushed it up with this bond to 41%, and we are working hard to be on track to reach 50% by end of 2025. We have also increased the sustainability loans to 56% from 36% a year ago. If we split up the different segments, in terms of the operations, for retail, we continue to have high occupancies of over 97%, and this is comparable to 1 year ago, which is also about 97%. For many of malls, we have high occupancies, and particularly for Xizhimen, Xuefu, and Nohemule, we actually have almost 100% occupancy, more than 99%. In terms of rental reversions, we enjoy a 0.5% positive rental reversions in first Q. This is driven very much largely by the leases that we have signed for the supermarkets. I mentioned earlier that we are doing some work on some of our supermarkets in some of the malls. And for Xizhimen and Xuefu, we actually signed some very good supermarket leases, and that boosts the rental reversion for first Q. If we exclude those supermarket leases, as well as the Capital Mall Xingnan, which was outlier, you could see more generally how our retail business is doing. And if we exclude those two portions, first Q 2025 rental reversion will be about -1%, a slight negative, which is similar to our 2024 trend. We also registered single-digit reversions for our strong trade categories, F&B, and IT sectors. In terms of the tariff environment, we have reported earlier, there's minimal first order impact for our retail assets, predominant because our malls serve middle-income consumers, and our retailers and tenants have minimum reliance on US imports for their products. So very domestic in terms of the consumption, as well as very domestic in terms of the source of the products being sold at our retail malls. In terms of business parks, we maintain a stable occupancy of 83.7%. There are some oversupply situation in some of our business parks, but there are also some bright spots. In Xingsu portfolio in Suzhou, our occupancy remained high at about 94 to 95%. This is due to its strong positioning. We continue to have new demand for international companies, replacing the expired companies with minimum downtime in that location. This location has slightly more international tenants than the other business park location, but we have assessed it. There's been limited direct impact from the tariff increase. There are some manufacturers who are affected, but they are a really small handful of our 3,000 leases system-wide. The Xi'an portfolio, AIT, we had last year reported a vacancy that continues, that requires to be filled. We have managed to fill it up somewhat from 71% last quarter. We have filled it up to now 74%. We're still working hard at it. For AIH, the occupancy has remained high at 91%. So we see improvement from there in terms of occupancy with new tenants, ICT and electronic sectors. For Hangzhou, we have reported previously, it is a very difficult market because of the supply situation. Even though there's been a lot of new leases being signed on, there's also been a lot of churn of tenants. So if you look at phase 1, our occupancy is 71%. Phase 2, there's been a drop to 70%, and that has declined due to the pre-termination of the service office tenant, which used to occupy 19.8% of the NLA of phase 2. So by March of 2025, when we found out, we quickly took action, and CLI's property manager had backfilled about 8.8% of NLA. That's 45% of the vacanted space, and another 3.2%, that's 15% of the vacanted space, will be filled in April 2025. We are directly engaging the subtenants and continue to push up occupancy from the vacated space. The silver lining here is because we have the service tenant, the service office tenant was a master tenant, so their rentals was generally lower than the market. So when we now sign with the subtenants, we managed to get double-digit reversions for those new leases signing. In terms of the logistics parks, we reported in previous quarters that we have managed to stabilize that portfolio. It now has a high occupancy of 95 to 96%, with full occupancy for 3 out of our 4 logistics parks. In Shanghai Fengxian, our biggest logistics park, we managed to secure anchor tenant in December 2024. That's for the whole facilities, 100% occupancy. Wuhan and the Kunshan Logistics Park, 100% occupancy. Chengdu Logistics Park had a decline in occupancy to about 93% due to some expiries in F&B and logistics and warehouse. It's currently in transition. We are signing on more tenants, and we should be able to bring it up closer to the high 80s as we bring in our pipeline tenants to bring up occupancy. In terms of tariff impact, I shared earlier, out of our business park, only Singsu has some very small handful of tenants who may be affected by US, have some US exposure. For our logistics park, 3 out of 4 logistics park focus on domestic distribution, so no impact there. Our master tenant at Shanghai Fengxian Logistics Park handles export activity, but they have very limited exposure to US market. So they are very unlikely to be affected. And in fact, they have confirmed to us that they're committed to our facility. They have signed an 8-year lease. And in fact, they are now carrying out CapEx to finish work so that by July, they will start contributing to rents. Portfolio overview. I'll just touch on some of the data points in each of our asset class, just to give a little bit more color of how the general performance is doing. For retail, if you look at our portfolio shopper traffic and tenant sales, traffic in first Q grew by 2.4%. Tenant sales in first Q dropped by 2.4%, but that's a big factor of that is because of the supermarket upgrading that's happening in Wangjing, Xizimen, and Xuefu. If we exclude the supermarket, first Q tenant sales would have increased 0.7%, and tenant sales per square meter would have increased 4.3%. Generally speaking, our traffic and sales have dropped a little bit from first Q from 2024, and we are watching closely, but we hope that with the stimulus that's coming in, it will start to improve. In terms of occupancy costs, it is a very healthy occupancy cost of 17.7%, lower than pre-COVID-19 levels. In terms of key trade cats, happy to share that we see strong growth in some of our key trade cats. For F&B, we continue to see good growth of about 4.7%. We also see increased trade mix in F&B as more retailers and more F&B retailers take up space in our mall to serve the increase in demand for food and beverage outlets. In terms of IT, it's a strong growth at 22% in first Q. We see a good boost from consumption vouchers given out by the China government during that time, and certainly helped our sales at our malls. And that includes things like phones, gadgets, which are eligible for the consumption vouchers. In terms of leisure entertainment, that had a big boost from blockbusters locally. The show Nerza attracted many shoppers to come to our malls, to the cinemas to watch the shows. So you can see that there was an 11.6% increase first Q year on year for leisure entertainment. And jewelry continued to have strong performance, plus 8.8%. Sales increase as people continue to buy jewelry for the festive season of Chinese New Year. In terms of business park occupancy, if you look at our business park versus the sub-market occupancy, you can see that we are outpacing or on par with those sub-markets for almost all our business park sectors. Particularly, if you look at Hsinchu, and it has a very strong outperformance, as well as Hangzhou. AIT and AIH is about on par. Next, let me go into capital management. Joanne will take that part. Generally speaking, we are trying to push out our proportion of renminbi debt, and we have a target by end of this year to reach about 50% in terms of our debt in renminbi debt.
Thanks, Jerry. On this slide, you can see that in terms of our total debt as of 31st March has actually increased a little bit. I think largely because of the use of the debt to actually pay some of the distribution in March. That's also explained in terms of the gearing has also gone up from 41.9% to 42.6%. I mean, because of the temporal timing difference that we have to actually borrow offshore to pay our distribution. But having said that, I think some of the distribution onshore that is coming back to Singapore are actually on track. In terms of our average cost of debt, I would say that it's pretty healthy and stable. As of 31st March, is at 3.51%, no change from December last year. And then in terms of ICR, is also healthy at 3 times, also no change from last year. If you look on the right side, we also have actually a sensitivity table in terms of what MAS actually required the REITs to actually show. For every 100 basis point increase in terms of interest rate, that will actually move our ICR from 3 times to 2.3 times. And for 10% decrease in our EBITDA, will also move the ICR to 2.7 times. That is still well within the MAS guideline of 1.8 times. In terms of average terms to maturity, with the new initiatives that the REIT has done, we have actually extended the maturity years from 3.4 years to 3.9 years. And as what Jerry has mentioned just now, that we are actually working towards more RMB loans vis-a-vis the Sing dollar loans on our total balance sheet. And if you look at it on the sensitivity table, we are also looking at RMB loans interest rate to actually come off. And if that's the case, that actually will help to improve our DPU vis-a-vis what we are seeing in terms of the Sing dollar debts, where the increase of the loans is actually will have a negative impact to our DPU. In terms of maturity profile, look at it, 2025, we have all our loans refinanced. In fact, although there was actually no loans due for refinancing in 2025, we have actually took a proactive initiative to actually early sort of like replacing the higher debt, Sing dollar debt that we have with the renminbi debt that we have. Like just like what we have mentioned, we have done the 3-year renminbi 600 million loan bond at 2.88%, which is better than what we have done previously last year at 2.9%. That brings our total percentage of RMB loans to Sing dollars from 35% to 41%. Our fixed rate is also healthy, standing at 31st March was at 75%. And if we were to actually include the fixed, the Sing dollar, so the renminbi loans as actually fixed, this proportion will actually be 86%. Yeah, that's all I have in terms of the capital management. Maybe I'll just pass on back to Jerry to round up the rest of the updates.
Thank you.
Jerry.
Thanks, Sharon. So looking forward, in the next few quarters of 2025, of course, we'll be working hard on capital management, which Joanne has very nicely outlined. The other part is, of course, that we have to continue to sweat our assets. And one way to do it, one main way to do it for us is to work on AEIs to continue to optimize our retail portfolio and enhance return. we are sharing today 3 initiatives that we are doing. The first one is an ongoing AEI at B1 of Capital Mall Wangxing. This is an opportunity that we identified to recover supermarket area in the mall. The space is about 8,800 square meters from a supermarket, old supermarket that was outdated, but a little bit too large for its size, and did not basically catch up in terms of trends of the new supermarkets that are in the market. Right. So what we have done is we took back the space. What we're going to do is we're going to refresh the tenant mix. We're going to introduce a new retail concept, Supermarket 7 Flash by JD.com, as well as include in the space 20 other popular retail and F&B outlets, increase product selection, and revitalize our shoppers' shopping experience. This will be, in fact, our second 7 Fresh outlet. This builds on the success of this Capital Mall Grand Canyon, where we launched the new supermarket in 2023, and in 2024, that 7 Fresh supermarket actually produced a GTO per square meter of 3 times of the previous supermarket setup. So we expect similar performance in this new supermarket that we're getting. And then, of course, we'll get higher use from the revamped area from the 20 retail outlets and F&B outlets that we are cutting out from the old space. So in all, we should be expecting about 10%, more than 10% ROI for this whole AEI. In terms of our leasing activity, we are showing good progress. We have already signed on 53%, and then there's another 24% that we have advanced negotiation with. We expect to open this space in 4th quarter of this year. The next AEI is also a supermarket replacement at Capital Mall Xuefu. Here we are working with a very hyper-local supermarket operator called BUT, and they are quite well known for its supply chain management capabilities in Northeast China. And they offer very good quality products at attractive prices, and they have a way of laying out their supermarket such that it attracts shoppers in that region to buy more things from the supermarket. Right? We have actually some experience again with this operator. They are currently already now in one of our malls, Mentun. And in that mall, when this BUT opened, it also had a sales effect of 3 times of the previous supermarket. We expect a similar good results from Capital Mall Xuefu when this supermarket opens. In addition to the supermarket side, we are also integrating animation, comics, and games themed street concept area, about 17,000 square meters of it, in order to attract the younger generation. All this supermarket plus the animation, comics, and game street, capex wise, will be borne by the tenant itself. So it's a very good deal, exceptional lease that we managed to sign on, a very good project, and we expect total rents from this area to increase by 10%, even though we do not put in any capex. 3rd Q 2025 is when we expect this new area to be open. Finally, Capital Mall Shizimen, we are also undergoing another anchor supermarket upgrade. This time around, the old anchor space of about 10,000 square meters will be transformed into a new area called DTX Concept Store. This is a new retail concept that's inspired by SKP, which is one of China's most successful departmental store. It is a luxury departmental store, but they have started a sub-brand that is community-based, more boutique, but continue to target mid to high-end consumers, but with a younger, more accessible take on the SKP model. Right? The anchor space basically will consist of a premium grocery, a boutique retail that builds on the SKP global procurement network, and also some curated social spaces, including cafes, bookstores, and dining venues that will allow our shoppers to have some good experiences. So by converting this traditional supermarket space, which was previously slightly outdated, into this more dynamic high-yield retail area with better curated offerings, the upgrade will elevate actually our whole mall positioning and drive benefits for all our tenants. We expect the opening as well as of this space in fourth Q of 2025. Finally, in summary, these are the few areas where the REIT and the REIT team in 2025 will be focusing on to deliver value for our unit holders. One, the C-REIT initiative will create value by having the opportunity to enter the growing C-REIT market as a key stakeholders in CLCR. This will broaden our access to China's domestic capital market and provide us with another avenue to unlock value and recycle our assets. And for unit holders, there will also be upside potential from the C-REIT units exposure. Unlock value through the C-REIT transaction. We will be able to recycle capital more Yuhuating. The unlocking of value from this mature retail asset will help us to improve financial flexibility. Extract value. I've introduced some of the AEIs, the 3 AEIs that are involving supermarket upgrading and supermarket replacement. And with this initiative, we'll continue to grow our retail portfolio and our MPI organically. Proactive capital management. We shared that we issued 600 million of bonds at 2.8% renminbi bonds, very competitive rates, and as well as post-issuance increasing our renminbi debt denomination to 41%. We will continue to do more of this issuance and continue to take advantage of the decreasing of the easing and decreasing interest rate environment in China. So with that, I would like to thank you for listening to my presentation. If there are questions, I'm happy to take them now.
All right, thank you so much, Jerry and Joanne. If you have questions, please type them into the chat box. There is a question already which relates to your listing of the C-REIT. Please share the thoughts behind starting the C-REIT with only one asset from CLCT. Would you like to take this, Jerry?
Yes, sure. When we went about, this C-REIT initiative actually took about almost 2 years to gestate. In fact, it does take some time for the regulators in China to go through the assets and to finally approve it for potential listing, right? So at that time, of course, one of the things that we wanted to identify asset that is not so big, because if it's too big, it may be a bit disruptive in terms of our cash flows. So we wanted to choose one asset in that category. We also want to choose one asset that's pretty mature, as we shared in previous quarters. Yuhuating is one of the assets that we have done AEI in 2023, and we have reaped the benefits in 2024. So it is at basically a level of MPI which is pretty mature, and we saw that possibly in the midterm there wouldn't be much more value that we can extract out of it. So we thought that therefore Yuhuating was a suitable asset to put in, right? In terms of the overall size of the C-REIT, if you look at the press release, it's about 3 billion. That includes Yuhuating and Sky Plus, the 2 assets. And 3 billion is more or less the sweet spot, for initial IPO for C-REITs, retail C-REITs particularly in the market. So those are the few criteria and a few considerations that we took into account, when we selected Yuhua as the seed asset from CLCT.
Right. But you've got approval already for the listing or not yet?
No, it's actually undergoing approval right now, the last stage of it. Yeah.
Okay. So it looks like it will be approved.
We hope so. Yeah, we hope so. Yeah, but obviously, only when it's approved. Yeah. So
Okay.
of course, it's on our side, it's required for us to go to our unit holders. So the final approval will be after our own unit holders EGM approval.
Yep. Okay. All right. There's another question for the supermarkets whose leases are changing hands. What is the expected downtime before new leases start contributing rent?
Okay. Maybe I like Yu Hong, who's the head of IPM, take that question.
Yes. Typically our downtime for the replacement is about 6 to 9 months. I think in some of the cases, actually, such as Wang Jing, the landlord will carry out the AEI, and in some of the cases, the tenant actually is the one actually carrying out the AEI. In the case of Xizhimen and Xuefu, it is the tenant that's actually carrying out the works.
And I would add, for the three AIs that we spoke about, we already have the main anchor tenant, which is either the replacement supermarket or new concept supermarket, already basically locked in before we started, the AEI or the replacement works.
Okay, thank you for that. Okay, there's a question basically on your business parks and logistics. The first question was Daniel Yu saying that the speculation that the sponsor dumped the assets onto you. And the last question in the list from R. Huang, what is your plan for business parks and logistics? They were born out of COVID. Are they still relevant today in the portfolio? And what is your plan for them?
Okay, thanks for the question. Okay, so maybe I first clarify the two asset classes. Business park we did buy from sponsor, but logistics actually was a third-party purchase, so nothing to do with the sponsors.
Right.
So that's number one. Two, if you ask me whether business park serve a purpose and logistics serve a purpose, I would say yes, because if you look at the retail portfolio worst moments, that would be 2021, 2022, when a lot of rental rebates were required, right? You can see that NPI for the new economy assets, which is business park and logistics, actually went up about 19 million Sing dollars during that year in 2022, whereas the retail portfolio actually went down about 15-16 million Sing dollars. So in some cycles, certainly the business parks have different correlation as the retail, and therefore help to be a diversification
Cushion the flow.
Right? Yeah. But of course now the cycle has turned, right? It is a cycle that has more resilience for our retail assets. So of course, if you're looking at this snapshot now, you will say that the retail assets, of course, is the best asset to keep, and the business parks is weaker, right? So I think we should look at different cycles for the long term, and from that perspective, I would still feel that there is a good use for different asset class for diversification purposes. Of course, we are constantly reviewing to see that if we look into the future, which are the asset classes that are more resilient, and if we so find that there's fundamental shift or structural shift for certain asset class that we no longer feel that in the long term they suit our portfolio or a resilient asset class, we may take the decision to reconstitute and recycle those assets. But for now, I think business parks is something that is still very much in our portfolio mix.
Okay, thank you for that, Jerry. Two questions which were submitted in the chat box are actually quite related, but relating to the share price, or rather your unit price decline over the last few years. I don't know how to. Would you like to comment on this? share price has been dropping during the last 4 years. You have moved from retail malls to logistics centers and business parks with higher cash generating assets. How is the REIT poised to grow with the focus on C-REITs?
Okay. First, I must acknowledge that the unit price did drop, right? I mean that's certainly factual, but there's been a lot of there's been a lot of environmental factors that are sort of our control. For one, the economic situation in China, right? That has certainly taken a turn from since COVID, right? Everyone had expected that after COVID, the economy will bounce back, but it took far longer than anyone expected. Number two, globally interest rates have remain high. Of course, now we see China interest rates starting to come down, but the high interest rate did have an effect for all REITs. In fact, not only our REIT, and sort of caused a downward pressure on the unit price. Then thirdly, of course, you would have heard the ongoing geopolitics, competition between China and US, right? That certainly have basically punished some of the counters that are associated with China Place, right? And ours being one of them. So if you look at for example, the most recent example of the tariff announcement of the 145% tariff by US, even though my portfolio, as I explained, has really no first order impact because a lot of things are servicing domestic consumers and domestic clients in our portfolio, right? Immediately, there was a panic flight, and that was when you saw a big dip. I think maybe about 2 months ago, right? But of course, things have since recovered after our explanation as well as our announcement of the C-REIT initiative, and the stock price actually gained quite nicely, about 15 to 20%, back to the levels of now, right? So it's indeed a very volatile situation, and I do feel with unit holders, but there are indeed some factors that difficult for us to control. What we are doing now, as you can see in our strategy, is that we're working hard at assets, sweating it in terms of AEIs. We are trying to cut costs both at the mall level as well as our financing costs through active capital management. And recently, of course, we embarked on this C-REIT initiative, not only to basically sell some assets and unlock value and decay a bit, but also to present to the market a sort of a value arbitrage that they can observe for themselves. Because what we're trying to say is in the S-REIT market, if you look at my REIT I presented earlier, my yield is about 8%, right? But in the C-REIT market, for similar sort of assets, when we list it, we are projected a trading yield of for the C-REIT of about 4 to 5%. And it's not just us. Many of the players who have listed their REITs are trading around those yields. So it does seem to point to, at least currently, right, that there is some value of some of our more mature assets to be sold to the C-REIT markets to sort of close that NAV gap between our trading price versus our actual value of properties.
Okay. Okay, we have only got a few more minutes. I'll take one of the pre-submitted questions, which is, you've mentioned the impact of the tariffs as being minimal and so forth. But one question that was submitted prior to this is, have your mall seen lower foot traffic in recent days because of lower purchasing power by Chinese consumers?
Good question. I would say, generally speaking, the traffic is still growing, right? Because end of 2024, I think I recall about +8% traffic growth. And then of course first Q we had a small growth as well, right? I think that shows you that traffic is still growing, but I would acknowledge that the sales levels are generally lower in terms of maybe sales per customer, right, or ticket size per transaction versus pre-COVID, right? One of the reasons is, of course, people are worried about the economy, right? So if they used to spend 150 renminbi for a meal at a restaurant, they may now choose something that is more value for money, say 100 something that is below 100 renminbi per meal. So that effect is in fact happening. We see that in a few places in terms of what they spend on, they prefer more value for money offerings and less more non-discretionary things versus discretionary items like fashion wear, right? So that would be how I'll answer it. In terms of the trend, third Q and fourth Q of last year was actually the weakest retail sales China-wide. But after the government started to provide some support through its stimulus package, including consumption vouchers and trade-in programs, we did see a general uptick in sales. Right? We hope that continues to carry on. And I actually explained earlier in first Q, we saw some key categories that benefited from that.
Okay, thank you, Jerry. All right, one last question just before, and for the rest, guys, don't worry. The questions that have not been answered will be answered eventually by the company and posted on their website. So just this last question, Jerry, for the asset to be injected into the C-REIT, what is the expected sales price? Is it going to be at NAV or at a discount or a premium?
Okay. We have not actually disclosed the actual divestment consideration yet because actually the whole process need to undergo an IPO process. So it's actually there's a book build that's required, right? But rest assured, because it's we need to go to an EGM, right? And during the EGM, one of the criteria is that we need to have valuations done. In fact, we need to have two valuations done, right? And the rules for such IPT transactions is that we cannot, the REIT cannot sell below basically the lower than the lower valuation, right, of the two valuations. So all in all, right, I think we'll be in and around the valuation that we are currently at. Yeah, I cannot tell you that whether we are premium or not.
Okay.
But we in and around valuations. Yeah.
All right. Okay, then I think we'll wrap it up for the night because we have overrun slightly by about 5 minutes. Thank you so much to the CapitaLand China Trust senior management for taking the time to answer our questions and deliver a very enlightening presentation. Thank you also to Jeff Howie, market strategist from SGX, for his update. Very enlightening as well. Before I go, I just want to point out that this webinar will be available for viewing on SIAS's YouTube channel, and that the questions that were not answered will eventually be answered. Corporate Connect is a bi-weekly webinar, so please visit the SIAS website to find out what are the upcoming initiatives that SIAS is planning. The next Corporate Connect is happening next month and will feature HRNet Group. With that, once again, I thank everyone for joining us. Thank you for all the participants and attendees for taking time to spend this time with us from 7 to 8 at night. And we'll see you next time. Thank you again and good night.
Thank you.
Thank you.
Thank you.